welcome. You're listening to The Best of Investing on Talk 910. You know our show. It's where we discuss valuable information about real estate, the financial markets, and other economic business of the day. I'm your host, Edward Brown, and I'm proud to have as my co-host Mark Hunt of Pacific Private Money, California's fastest growing mortgage investment firm, and Kathryn Harris, CPA of Parati and Karat. Our phone number is 888-912-1190. Write that number down, 888-912-1190, because you're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. That's right, we're giving away 9 vacations. See, I didn't even need to take off my shoes and socks to figure that one out.
Nice.
3 vacations each commercial break. There's 3 commercial breaks. 3 times 3 is 9. There you go. 6 years of high school, like I said. Okay. The vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, which is located 1 hour northeast of San Francisco. And in fact, I just found out Lighthouse is teamed up with NASCAR. So if you because Lighthouse Resort is a private resort, and NASCAR has a deal with them where it's open to the public if you belong to NASCAR, and I think you get to go for like $45 a night. So it's cheaper than regular camping, and it's pretty cool. Okay, check them out, lighthouseresortmarina.com. So anyway, the vacations on the show here are free. Their only request is $75 cleaning fee to cover housekeeping expenses, and that's obviously if you stay in a cabin. If you tent camp, then there's no cleaning fee. Their website is lighthouseresortmarina.com. You can reach them at 916-777-5511. And today's trivia theme is kind of different. It's going to be the middle child on TV.
Interesting.
Oh.
Okay? You'll understand when we get to the question.
I am a middle child. I feel their pain.
Okay. Okay, that's the first question in the Harris family. What? No. Okay. Our website is bestofinvesting.com. Check us out on Facebook and YouTube by typing Best of Investing Radio Show, and we're also on television. In fact, Mark just got hounded by his fans who saw him on TV. The paparazzi, yeah. Comcast Channel 26 and AT&T 99. Saturdays at noon, Sundays at 6 p.m. Now, Kathryn, let's start with you because you found a couple of interesting articles.
Yeah, I found two different ones, different topics, so we'll see how far we go, where it leads us. The first one is one that I've seen this article kind of over the last year or so, and it's U.S. home ownership rate falls to a 19-year low in the second quarter. And it really, I'm sorry to kind of go into policy, but it kind of brings into the policy of the government. The structure of a lot of tax laws, the deduction of interest, of your home interest, is to push a policy. A lot of things that the government, what you guys don't realize, or excuse me, the general public doesn't realize, either it's tax law or exactly, yes. Tax law or other type of policy. Sometimes you only see on the surface, but you don't realize they're usually trying to push something.
Sure.
Beneath
agenda.
That. There's an agenda beneath it. That homeowner deduction isn't because they're generous. It's because they want the United States and the citizens of the United States to own homes. It provides stability. It provides stable jobs and the trickle effect of the economy. So to see this home ownership fall to the 19-year low, so about 19, which is kind of scary when you start to see it. I think it was, they don't say it here, but that's 1995 is 19 years ago.
Can I ask you one quick question? This is more philosophical about this. Partly, I think you're right with regard to the stability, home ownership, and all that. Do you think part of it too could be just the fact that all of the various trade people who are in real estate, i.e., real estate brokers, the agents, the mortgage brokers, construction people, et cetera, et cetera.
The lobbyists.
Yeah.
Or the real estate industry.
So it's. I mean, you're employing a whole bunch of other people too. So it's not just necessarily, gee, we want everyone to own a home because that's the American dream.
Exactly. Well, it does, and that there's a very significant industry, and when home ownership falls, there is an impact, which was you can see the blow up that happened when too many people got involved and they spread a little too thin.
Sure. Their
requirements. But yes, it has a huge impact, and that's one of the reasons why the government. I'm curious because if U.S. homeownership has fallen, that means something else has picked up the steam or has picked up the lag of what has been pushing the increase in home prices over the last 2 years.
Rental real estate.
And it's rental real estate, and a lot of it is how much is it American owned and how much is it foreign
Oh, yes.
investments. And that I'm curious to see if the federal government's going to step in at some point in time, or if that's something they've been keeping their eye on.
Well, interestingly enough, we had a real estate agent on before, and we were talking about how the Chinese were buying up a lot. I received a scathing email from a listener. It was as though it was my fault, and you tell those Chinese to stop buying up San Francisco. It's like, oh, okay, I'll do what I can.
They have to do something with all those dollars that they're collecting.
Yeah. Exactly, and if it's not going to be in the bond market or the U.S. Treasuries, let's just go buy American properties. Sure. And it's an American dream, and it's an international dream to own a home in the United States. I understand that. I have a lot of people, and I know a lot of people who have the desire, and I know a number of people who are from China, and that is where they want to be. They want to have properties. It's pride.
I was going to say, because they don't actually come here to live, they just want to own it in their portfolio.
Exactly. Yes, they just want to say, I own it.
It's like having a Van Gogh painting or something.
Yeah, exactly.
So you mentioned, Kathryn, that that government policies have affected this, and one policy in particular was the policy that everyone's entitled to own a home, or maybe it's not a policy more than it was a belief in the government that went back as far as the Clinton administration, and that's what led to a lot of this easy money that was being printed up in 2000s and led to the liar loans. It was pressure by the government on lenders to open up basically their underwriting guidelines and make it the floodgates and make it easier for people to buy loans. Hence, we end up with the easy money that leads up to the real estate bubble. And I'm going to guess that if you've got the chart there, that's probably showing 2005 or 2006 as the peak of home ownership. And now, 7 years later, we're at a 20-year low in home ownership as the real estate bubble popped as a result of what we all know happened. And now we've converted a lot of those homeowners that bought homes between 2000 and 2006 to renters or back to renters. And
you mean the renters they bought and then went back to
so there was a conversion from renters to buyers in the run-up from 2000 to 2006, and then
how much of it is almost like a natural correction, because they're saying the peak was in 2004, which is interesting to see how it was the peak in 2004, but I think as it started to crumble, it takes a while before it really hits.
But you're saying it's a 20-year or 19-year low, so that would reason that more than just the new home buyers got affected, but lots of other home buyers, including people who maybe borrowed against their property and refinanced and then ended up with a loan that they could no longer afford. So there's a lot of
so potentially they lost two homes if they use that to buy another home.
Yeah, so a lot of people are playing into that, but yeah, I mean, homeownership is a good thing. It's the government definitely has been promoting that for years, and anytime you hear talk about eliminating the home mortgage deduction, as much as it makes sense from a purely laissez-faire, let's not influence the real estate market, it should be driven more by market factors and on and on and on, which I believe in a lot of that. On the other hand, I am personally a proponent of the home interest deduction because I do think it is one of those things that is good for the long-term health of the country, and we need that.
All right, we're going to cut to our first commercial break here. Again, the theme is Middle Child on TV. On Bonanza, what was the name of the middle child? He's talking about a show that goes back to the 60s, all right? The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. On Bonanza, what was the name of the middle child? All right? Make sure to include your name and your email address. Speak slowly. Spell out your email one letter at a time. Don't touch that dial. The best of investing will be right back.
I have an answer, and I'm not telling you until
Good.
we're back on the air.
Remember, that was kind of
Kathryn.
I have no clue.
That was her favorite show.
Close.
Not Banana Bonanza.
That was a bozo no.
Yeah.
Grab it, honey.
You remember that?
I do. I know it's an old story. I almost thought it was an urban myth. But,
no, it's that was
really
true.
happened.
There were two
contestants?
No. There were two different ones. Oh, okay. So one of them was basically this kid on Bozo the Clown, okay, the old TV show, and this kid swears on national TV.
Oh, really?
And so Bozo, he goes, that's a Bozo no. And so the kid looks and goes, cram it, clown. And the other one was, the kid takes his nose and throws it in the audience. I like cram it, clown.
Oh my god, that is hilarious.
Well, you know why Groucho Marx got taken off the air?
No.
This one was a little risque, and this is back in the 50s, right? He has this contestant on, and she is a kind of a young lady, and he says, yeah, I understand you have a lot of kids. And she says, yeah, I actually have 8 kids. And he goes, you have 8 kids? And she says, well, my husband loves me very much. He goes, I love my cigar, but I take it out every once in a while. It's like, whoosh, you know, can you imagine on national TV back then?
That's great,
Yeah.
actually.
Yeah, that is.
Yeah, they sponsors don't like that stuff.
They don't like what brings like negative media. Once it's negative, it's
Yeah, especially back in the 50s. Can't imagine. All right.
well, that bubble just popped today, apparently.
Yeah.
Well, it could be. It could although, you know, this article says it may go higher before it goes lower. Yeah. And that's just him hedging. He's saying it's way overvalued, where it's going to
Stock
pop,
market.
but it may go up. Yeah.
Okay, let's kind of bounce back and
Go
forth,
ahead.
so let's go there. Okay. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hahn and Kathryn Harris. In fact, you know what? I started doing that almost 4 years ago, because what happened was I would just say, welcome back, and I'd start going right into it, and I received a scathing email from a listener saying, I never found out, you know, what your guy's name was. I had to
Who
listen
are
to
those talking voices?
These scathing voices, emails.
I know, it's terrible. She goes, I had to listen to the whole show until you finally said the end. I go, that's the plan.
That's right.
Okay, when we cut to the first commercial break, we asked a trivia question. On Bonanza, what was the name of the middle child?
I said Bozo.
Bozo. No.
Haas.
Haas, that is correct.
That's
Very
my
good.
answer to any trivia question about Bonanza's Haas.
Haas.
I just like that.
What was the older son's name?
I just know Haas. I'm sorry.
Adam? Yeah, there was only one child. It was Haas,
Followed Michael
and then little
Jackson.
Joe. Yeah.
My name is Haas, and my brother Haas, and my other brother Haas.
Well, you had Ben Cartwright had 3 wives, 3 different kids from 3 wives. They all died
Oh.
on the show. I mean, this
Oh,
is
okay,
on
I
the
was
show,
like,
yeah.
oh my god, no, they did not name each
I didn't even know
child.
this stuff.
Yeah.
Well, George Foreman named 6 of his kids George.
Like George and Georgia. I
Yeah.
think that's where they're.
Well, that way he says, George, take out the garbage. He knows at least one of the kids is going to answer. Okay, so Mark, on July 31st, the stock market went down 317 points, which gave up all, apparently, of its July gain. Can you imagine that?
Not even just all. I think I can't remember what index. Almost all of it for 2014.
Oh, the whole year?
Yes.
Oopers.
Owie.
Yeah, well, you know, we talked about on this show, it was probably 4 or 5 weeks ago, I had seen an article in Forbes magazine, and one of their staff writers showed a bunch of charts and graphs and was predicting that the stock market, in his article, was overvalued by approximately 50%, and that he was portending a stock market, not necessarily a popping bubble, but he was saying
Correction.
correction. He was expecting a correction, and it also predicting that stock market returns over the next 5 to 10 years may be disappointing based on how high he thought stock prices were relative to the values based on his charts and graphs. So, and here's this week we have another article. This was out of the off the Wall Street Journal's website. They've got a division called Market Watch. And so one of their writers wrote an article that quoted a gentleman by the name of Andrew Smithers. I don't know if it's the same Mr. Smithers from
Simpsons.
The Simpsons.
Mr. Smithers.
So I must say that I didn't get a chance. I was going to Google this guy and make sure that this guy was actually reputable. But I assume if it's on the Wall Street Journal editorial, that probably the guy has got a little bit of stock behind him. Yeah. So anyway, he starts out his article by saying, "What do the following years have in common? 1853, 1906, 1929.
I know the answer to this.
1969 and 1999.
They all hit peaks.
Yep.
Yep,
Those were the peaks of the 5, what he calls generational stock market bubbles in U.S. history. And he is predicting that we are in yet another, even though it's only been, not a lot
15 years.
Yeah, not a lot of years from 1999, 15 years. He predicts that we're in another stock market bubble. In fact, and this number is a little bit shocking. He says U.S. stocks are now about 80% overvalued based on certain key long-term measures.
But he's not predicting that it's going to go down to 80%, though, is he?
No, he's not. He's not predicting. In fact, he's not predicting. He's not saying this bubble might burst. He's saying maybe the stock market. He says it's likely the stock market will continue to go up before it goes down. But it's just whether or not. I mean, there's bears in who write about this and all the time.
Well, I can give a prediction that I know is 100% accurate. The
Lots of confidence.
Are you ready? The stock market will go up, it'll go down, or it'll stay the same. It's got to be one of those three.
But it's just interesting. Now, here's yet another one. Now, of course, it's certainly easy to get noticed and get written about in papers when you're running around screaming the sky's falling.
Yeah, sure.
So, and this is one of those times when the stock market has done incredibly well over the last several years. Of course, last year, 2013, we had nearly a 30% run up in stock indexes. So you've got 2014, and we were having a pretty good run, and then we had a pullback where we lost most of the gains of the year, and yet this past week we had another pullback. And we talk about a lot of different investments on this program, and those who've been listening for a while know that I'm a fan of mortgage-backed investments. And of course, we all, we talk about real estate, and we know what real estate's gone through since 2008 and that bubble bursting.
Yeah, but the thing is, your clients didn't lose any money.
Well, the news about our company, why I love mortgage investments, is because we've been making loans on real estate since the bubble crashed. And of course, some are arguing out there that we're in yet another bubble in certain markets like San Francisco and Silicon Valley. I don't happen to agree with that, and we can talk about that a little bit later, maybe if we still have time. But conservative loans secured by real estate mortgages are a very, very lucrative way to earn above market returns, especially in markets like we're in now, where if you believe the stock market is potentially overvalued or due for a correction, what's the answer to the question? Well, what do I do with my money?
Yeah, because otherwise,
where do I put it?
Principal,
right. Do I sell stocks now? What if I have gains in those stocks? There's tax matters you have to consider there. But for those of you who are, looking for a place to at least diversify, if you're going to maybe wean from stocks from your portfolio of investments, one thing that you owe it to yourself to visit and take a look at are mortgage-backed investments like individual trust deeds, which are individual notes secured by real estate, or mortgage pool funds.
And what kind of yields are you seeing?
Well, we've been paying consistently 8 to 8.5% on our trust deeds and our mortgage pool fund. In fact, our mortgage pool fund is at exactly 8.5% right now for the last 12 months, and it's backed by a real estate portfolio of notes that have a loan-to-value weighted average of 60%. So we're not talking 80%. You don't have to go out and take abnormal risks or super high risks to get great returns. And 8% really is a great return.
That's a phenomenal return over the course of several years, and that's something you should point out in this is when most people who invest in the stock market, layperson people are not doing their due diligence when they look into what stocks to invest in. They're usually just listening to the news.
Yeah.
They're usually just picking up stock that Twitter Facebook that they're not too familiar with looking into their financials and looking at the health and what products they have to offer, and looking into making a really detailed decision. Whereas if you're going into these mortgage-backed securities, it's pretty straightforward, and the statistic, you only have to show, you don't have to do a significant amount of research to get some assurance that it's a pretty safe bet.
Yeah.
And as you pointed out, Edward, it was that it's been, sounds like for the last 5 years or so, no loss on any of their investments, principal.
Correct. And it's funny that you say that many people buy stocks just based on something they read in the paper. My entire stock portfolio in 1999, before the bubble burst, was based on exactly that. I'd see an article, some friend would say something at an event, it was all of these esoteric
You
tech
realize that
stocks.
by the time you hear it, it's public knowledge. It's already been built into the stock price.
Yes, you lost the opportunity to gain
Exactly.
the upper hand on that stock.
Yep, and so when the stock market crashed, so did pretty much my entire portfolio went down to almost zero. It was just
That wasn't so fun.
no, it was not fun.
All right, we're going to cut to, on that happy note, we're going to cut to our second commercial break. When we come back, we got, I want to find out deal of the week. We got a couple of interesting emails for our co-hosts here. All right, this one's a little harder. This show also was from the 1960s. I'm sorry.
Come on, man.
Come on, man. All right, the trivia theme is the middle child on TV. On the TV show My Three Sons, what was the name of the middle child? Now, there's 3 sons, so there is a middle child. Right? The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. On the TV show My Three Sons, remember that theme? Okay. What was the name of the middle child? All right. Don't touch that dial. The Best of Investing will be right back.
You got a really good memory, or you up watching like TV land?
Nick at Night.
Nick at Night, that's
well,
what it's called.
This is before,
Something, I haven't done-
Let's
I
put it this
haven't
way. This is
done
before Nick at Night. That needs to,
It's true.
you'll get the other one. The other one's a little easier.
It's from the 80s.
No, it's from the 70s, but it's well known.
It's gonna be like the Brady Bunch. I won't be able to. I can't remember the names. I call it second child syndrome.
Yeah. On the Danny Thomas show, but no, it's kidding. Wizard of Oz. Okay, on Sesame Street.
I actually do know it. I shouldn't say that. I know. I do watch for it. You know what it is? When I read books and when I watch TV shows and watch movies, I don't pay attention to names. I don't even know the characters' names. I'm not much of those people who pick up names.
Well, it's funny. Even I have gotten into. This is the first TV program that really kind of like followed a series, Revenge.
Oh God, I loved that show. I had to stop watching it. It was so good. I was thinking about it. But even then, like I can't remember. There's the girl and there's the guy, and then the guy, the friend.
Yeah, I don't even know what's her name even. It's like
Well, it's Emily,
Emily. That's
but
right.
it's really Amanda. Depending upon, I know. So even we sleep with one eye open, look at each other.
Sleep with one eye open.
You never know.
I'll have to wait till it's on Netflix now. Just binge watch it.
It is on Netflix, but
Oh, I gotta wait till it's almost.
2011 and 12 were on there. 2013 we had to go to Hulu Plus. My daughter had to get us onto that. Okay, ready? I don't know any of this stuff. Well, Hula Hoop what?
Yeah.
I used to have one of those. I can't do it anymore. I used to do it when I could wiggle. All right. Yeah. Yeah, I can do it on my arm. Here we go. Welcome back to the Best of Investing. I'm Edward Brown, your host. I said that really fast. Edward Brown, your host, along with Mark Humph and Kathryn Harris, CPA. When we cut to the second commercial break, we asked this trivia question about the middle child on TV. On the TV show, the old TV show from the 1960s, My Three Sons. What was the name of the middle child?
You stumped me there. That was never one of my favorite shows. That was too.
I know, but I actually didn't care for the show that much. But Chip. You had Robbie was the oldest, and Ernie was the younger. He was the adopted one.
I am impressed.
Yeah.
You know,
Well, the next question will be a little easier. Okay.
Promise.
So, Mark, continuing on with what we were talking about before, with deeds of trust and all that. Give us the deal of the week, and don't forget to give people your information so that people can call you.
Well, the deal of the week this week that in fact we just closed it a couple of days ago was a purchase of well, it's actually, I thought it was a single family residence. It's in Corte Madera, Marin County, legal duplex though, and we did the deal for them, 70% purchase loan, and the reason why this particular borrower needed hard money is not because he didn't have good credit. He had really good credit in the mid 700s. Wasn't because he didn't have good income. He's got great income. He's a noted in the doctoral field, let's just say, without getting too much information out there. Makes really good money. And it's not that he didn't have good assets. He's got great assets. He owns this place in the city that he was talking about, how much money he was making using Airbnb instead of renting it out on a monthly basis, which was a great story that I got to hear about. But it was because the only way he could get this particular property was on a very aggressive offer. In fact, he made an all-cash offer to the seller and told them he could close in 21 days. And that happens quite a bit in this market where we have tight inventory, and so there's not a lot to pick and choose from. And so this person knows he can get a bank loan. In fact, he will get a bank loan. What he didn't know at the time that he made the offer was that very few, if any, banks are really set up today with all of the new Dodd-Frank underwriting guidelines.
So they can't even get an appraisal that fast.
Yeah, so the bank could not make it happen. So he was not pleased to learn that, well, you have an option to use a hard money loan, also known as a private money loan. And so he told his broker, well, okay, well, give me some information. He did. He got a number of quotes and included our quote, and our quote was the most aggressive pricing that was available, but it's still, it was still a loan that we closed at 9.9% and 2 points for a loan that was about, close to $800,000 for him to be able to, which was 70% of the purchase price, a little over $1 million. And so this was, he had to take the long view, and the long view is that he believed he was getting a good deal, and the cost of acquisition, he just had to add to that the cost of this private money financing, and now he owns the property, he's got control of the property, and now he has the time to go out and get the very best loan available to a guy of his strength, credit, and income. But I'll tell you right now, at Pacific Private Money, 4 out of 5 loans we're doing today, and this was not the case a year ago or 2 years ago, but today, in the middle of 2014, 4 out of 5 loans we're doing are to help people close a transaction that they had originally predicted would be closed with conventional financing. So we're doing a lot of owner-occupied purchase, what we call bridge loans.
He's fulfilling the American dream.
Yeah, well,
yes.
that's, it's...
Well, not because it's now, there's a break in the system now.
Exactly.
Especially in the Bay Area, where for you to buy a home, you need that cash sooner than conventional financing will provide.
Well, the disconnect is really created by the lack of inventory to start with, right? So people are really anxious when they're in the market, and they know that they're bidding against a lot of people, some of whom really do have all cash and don't need a private or hard money loan, right? And so, the banks, it's a double whammy now that it's a faster paced market, but the banks actually need longer. They need 30 to 45 days on average to close excuse me, a lot of their financing. And so, the good news is there is an option available for people. It's just, it's relatively costly, but one of my favorite sayings is when someone says, well, is it expensive? And the answer is, well, compared to what?
Yeah.
Compared to not being able to get the real estate. So, real estate prices have been going up in the Bay Area. Many people believe that Bay Area real estate is a very good and strong investment. Therefore, if you're going to make that investment, the cost to acquire that investment has to be factored in. And sometimes financing and the cost of financing is going to be a little bit higher than you originally
Absolutely.
predicted. But again, in the long run, if the investment is a good investment in the long run, you're going to be better off than having passed on that investment. So.
Especially if it's house prices have been appreciating at the rate, we'll say they've been hovering around 10% for the last several months. So the next time that gentleman or individual has the opportunity to find a piece of property to live in, invest, rent out, they may have the price to acquire that property may have gone up just to almost offset what would have been your cost,
That's
your
a
fees.
good point.
So at some point, you pay it up now, or you may be paying it down the line 6 months from now.
So the great thing about this product that we have at Pacific Private Lending, which I'll tell you, by the way, not all hard money lenders out there today are making consumer loans. Most of them are set up to make investment loans and business purpose type loans. In order to do a consumer loan, we have to have additional licensing, and we do. We have to have the Mortgage Loan Originators licensing, which is also known as the NMLS number, the National Licensing Mortgage System. So we have that additional licensing, and we do welcome consumer loan transactions. And so the good news is that these loans, even though they're relatively expensive compared to a bank loan, there's no prepayment penalty on them. So we can close very, very quickly. It's not unusual for us to get a call on Monday, and the deal's got to close on Friday. And we get a deal like that because they didn't realize their bank wasn't going to be able to perform, and all of a sudden the seller's telling them, we're not going to give you an extension because we've got a backup offer. So you either perform or I'm going to keep your deposit and I'm going to sell it to the next guy. And that's just the reality in this market today. So we can make a very fast loan with no prepayment penalty. And it's very easy to do. Again, it's if you don't mind paying a couple of points and 10% interest for the amount of time that you need the money, it's a vehicle that's available to you to acquire real estate quickly. That's
And
really the bottom line.
how do people get a hold of you?
Well, we're at Pacific Private Money. We're here in Marin County in the Bay Area, and our phone number is 415-883-2150, or go to our website, of course, at pacificprivatemoney.com.
You can also go to the Best of Investing website, too. Tell you what, Kathryn, we're going to take a quick break. We want to give you a little more time because we have an interesting email for you, and then we'll get to Mark's email after that. And we'll close with the thoughts of the day, which are kind of fun.
Wonderful.
All right, this one's a little easier question. All right, the theme is the middle child on TV on the Brady Bunch. What? You see, on break, you said, I wonder if you have a Brady Bunch question. We are on the Brady Bunch. What was the name of the middle child? The middle son.
I was like, whoa.
Yeah, I was gonna say there was a girl and a guy.
Jan.
That's the girl. That's why I had to ask the guy. Okay, Marsha. All right, don't touch that dial because the Best of Investing will be right back. But you need to call 888-912-1190 to answer that question. On the Brady Bunch, what was the name of the middle child? And we will be right back. All right.
I wonder how it would feel to watch that show now. Like my daughter's getting into Full House, and it's so trippy to see just that show.
Oh,
like,
my daughter likes Full House too.
like
I don't know why she likes it.
but there's no phone,
So
cell
schmaltzy.
phones, and that.
Oh,
Oh
yeah.
my god. So I'm
Is that the one with
curious to kind of go back.
the twin girls?
Yeah.
Yeah. How old's your daughter now?
Well, I have one who's 6, and one who she'll be 2 in November.
I mean, it's a cute show. I've only seen it a couple of times, and I kept wondering, I go, why don't they have both kids at the same time? I realized that they switched them off. I didn't know that.
Child infant loss. Come on.
Full House.
But even that, I would just looking back, you watch one of those shows from the 70s or 60s, and
Yeah.
just what a different time.
Oh, I know. In fact, what does Superman do now? There's no phone booths anymore.
He has to go to
Well,
the
at
call
least
box
I,
instead on the freeways.
So,
That's
Lisa
good.
and I were reminiscing because we celebrated our 20-year anniversary this week, and we went out yesterday and we were saying, so 20 years ago, no cell phones, the internet wasn't anything to speak of, no one was on it yet. Just those two things right there was the majority.
How much of that take up of your day?
Yeah,
Those two things take up of
cell
your day.
phones and internet. That talk about how much life has changed in 20 years. It's dramatic. It just impacts every minute of every day and almost every fiber of your being.
So true.
20 years from now, I'll be implanted.
We won't even have to talk. We'll just think.
That's right.
Oh my God.
We'll be Lucy.
There's an episode like that on Gilligan's Island. Did not go well.
Gilligan's Island. Gilligan's Island predicted
Hey,
the future.
exactly.
All right, here we go. Welcome back to the Best of Investing again. Last time, I'm Edward Brown, your host. Not last time forever, just last time for the show. Along with my co-hosts Mark Hoff of Pacific Private Money and Kathryn Harris, CPA of Parati and Karat. When we cut to the third commercial break, we asked this trivia question. Again, the theme is middle child on TV. On the Brady Bunch, what was the name of the middle child?
I'm gonna guess Michael.
No.
Wrong again. Look there.
It wasn't Bobby, he was the third.
He was the third.
Ah,
Who was the third? Who was the second? Come on. Who was the first?
how about the first initial?
P.
Peter.
Peter. There you go.
You
Okay.
stumped the co-host.
Yeah, that's right. I had to get at least one tough one there. That was an easy one, actually. Okay, so Kathryn, we got an email that says, I'm searching for a new CPA because I don't think my current one is serving me well. Well, that's not a good sign. What should I look for in interviewing a CPA, and why do you recommend your firm?
All right. When you look for a CPA, I tell clients and people I meet with when I first do a consultation with them is interview a couple firms. Interview them as if you're looking for a real estate agent, as you're looking for a doctor. Why my firm or any one firm is, at least for me, I expect this relationship to be one that lasts more than just 1 year. This is a relationship that will be in communication for the next several years. And people have a tendency to only think of their CPA as somebody who does their taxes, but if you look at it in the long run, we want you calling us in your tax planning and maybe when you're entering in your major events, and then when you're starting to move into the different transitions in your lives. I have a family they're nearing retirement, and we're trying to do some strategic planning about selling some of their stock, moving some of those pre-tax dollars into post-tax while we have some low rates, while their income is a little lower, while they're starting to go part-time.
Well, the funny thing is, a lot of people will change their doctors before they'll change their CPA. I mean, that's how intertwined. My dad was a CPA for years, and he would tell his clients, don't go to the bathroom without telling me. I mean, obviously he was kidding, but it was like, don't, because a lot of times what happens, isn't it true? A lot of people do transactions, they come to you after the fact. Hey, guess what I just did?
Yes, and it's usually after the year. And once the clock turns to talking about Happy New Year's, right?
Yeah.
Time out. We'll have a little New Year's break. August is the month of your anniversary for the radio show, so happy birthday for you guys.
Thank you. 4 years.
But yes, they happen to call us after the new year, and usually once the clock ticks midnight on December 31st, there's not much we can do about it. So when you're interviewing, you need to go and interview a couple firms. We do say that, and you have to feel it out, just like you're filling out a real estate agent, as you're filling out a doctor. These are people you have to. Yes, your life isn't at stake necessarily, but it's somebody. Your finances, your retirement, your net worth is very important.
You got to feel comfortable.
You've got to, yes, you have to. And I actually had somebody said that when it comes to finances, it's something that's more intimate than what happens in the bedroom. You know, which to a lot of people it can be. People are more open about that than their finances.
That's true.
So you need to, and ask your questions. Do not be shy. You have to ask about the fees. If you don't understand something, ask, especially during the interview process. You get the opportunity to really get an understanding of who you would like to deal with. Why buy a firm? We're wonderful.
There you go. Well, I know I've referred a couple of people to me. You know, you show them good service.
We are located in Larkspur. There's about 10 to 15 of us, which is good, a nice size. I like a smaller firm.
That's a good size firm.
And again, to each their own. Some people may have the preference.
Well, the problem with dealing with like a large firm is you don't usually get the personal attention. There's a lot of turnover, and they're usually as expensive as anything.
Yes.
You go with someone who's too small, they can't really serve you well.
They can't serve you well, and if that person leaves, you kind of lose the history. And we're kind of like the Goldilocks, I think. Because there's usually not just one, there's usually two people on the account, just so that there's two people relatively involved. Not both of them are intimately familiar, but know who you are. We answer our phone calls. That's how it's been. The last 2 weeks, we've had referrals of people who just said we're not happy with them. They're not responsive, and we respond. We respond quickly with the emails if we can. If not, we respond to say we received it. Give us a little bit of time. We might be in the middle of a crunch.
You speak English too, right?
We do speak
Okay.
English. Yes.
I mean, when you get, a lot of times you call these places and automatically they start speaking, Indonesian or whatever, and then and then finally press 8 if you want to speak
Yeah.
English.
Well, yes.
It's like, come on.
Yeah. And or when you call us, and a human being picks up the phone.
Exactly. Yeah.
Even better.
And the same
Yeah.
person's there the next year. There's not this type of rotation where we have one person. It's not just the 2 or 3 CPAs in a rotation throughout the year and a new person every year.
I see.
We try to keep some consistency,
Consistent. That's good.
which is important,
Very nice.
especially with consistency. You know your clients.
Okay.
So
Oh, and how do people get a hold of you?
I can be reached at 415-461-8500. That's the best way to reach me. Give me a call. Again, we have a free consultation. We can go over your finances and your tax returns and answer any questions you have.
And Larkspur is good because that's pretty centrally located.
Goldilocks. Goldilocks of the
So there
Bay
you go.
Area, we'll say, of San Francisco to Marin.
All right, I like that. All right, Mark, question kind of back to you on this. How safe is your fund as compared to an individual deed of trust investment?
Great question. So again, my name is Mark Hoffman, broker and president of Pacific Private Money. We are both a real estate lender. We do hard money loans, which are also called private money loans, and we're also an investment company because we have over 200 active investors in our individual deeds of trust and our mortgage pool fund. So we have both products, and so I'm very familiar with the pros and cons of both. And in fact, we could take an entire show, and we have in the past taken an entire show to talk about the differences and between and the nuances between owning an individual note, which is also referred to as trustee investing,
But we only have 5 hours left on this program, so.
or investing in a mortgage pool fund. And
Keep asking.
the biggest differences are a mortgage pool fund is really for people who are unfamiliar with note investing. If you haven't been doing it for years, or you don't have someone you know who can guide you along the way, I really don't think individual note investment is the best vehicle for you. And the reason for that is because there's a certain amount of real estate knowledge and due diligence that's required in order to make a smart choice on buying an individual note. And I will say there's a lot of competition for the best note. So if you're not kind of in the circle and understand how it works, or have a pipeline to recently issued or newly available deeds of trust, you're just not going to see quality product. What you're going to see is the stuff that the pros won't take. In which case, you're going to probably be making an investment decision that you may regret. So again, mortgage pool funds are really designed for people who want to get that 8% yield or more, yet they don't have either the skill sets or the desire to spend the time that it takes to adequately look at those. In which case, you would want to research the fund manager and look at their track record. So the reason that people who invest in individual notes tend to prefer those is because generally they have the experience, they know what to look for, they know how to read a credit report and a preliminary title report and all the other due diligence information we collect on every borrower, and so they're used to looking at that. They're able to make a decision, and they like being in control. They like the fact that their money is investing in a note that's secured by a specific property and a specific borrower. And quite frankly, a lot of people who make those loans wouldn't mind owning that property. And so in the back of their mind going, well, what's the worst thing that can happen? Well, the guy stops making payments, I foreclose, I'll own that property, and I'll be even better off than I would have been had he paid my note, which of course didn't quite happen that way when the market turned. But again, we're at this stage of the business cycle. We learned a very, very hard lesson in 2007 and 8 and 9, and so we're hedging ourselves today when we make loans, so that in the event of another pullback, we don't suffer the same kind of loss of principal that certain people did when they were making, particularly when they were making seconds right before the market crash. So we're generally making firsts nowadays, no more than 70% of the acquisition price or appraised value. That gives a little bit of cushion there for anywhere from a 10, 15, 20, 25% pullback in pricing. And I'm not expecting that to happen.
No, but even if it happens,
But that's a safe cushion.
It is, and the thing is, even if it pulls back 27%, it doesn't automatically mean the borrower stops paying. if this borrower rides it out, right? Especially if they have a personal guarantee on it.
Right, exactly right. So again, mortgage investing is is the term we use to include the two primary vehicles, which are individual notes, also known as trust deed investing or mortgage note investing, and then there's the mortgage pool funds, which there were quite a few funds started in the last 5 years that are doing very, very well right now. They're very well secured with low average loan values. Like I said earlier in the show, the Pacific Private Money Fund, which has been paying 8.5% over the last 12 months, has a weighted average loan portfolio of 60% loan to value, which again is a very, very nice cushion for it. That helps a lot of our investors sleep well at night. So it's an individual decision. And for more information, please give us a call at 415-883-2150. That's 415-883-2150, or go visit the website of our fund, which is the pacificmoneyfund.com. Go to pacificmoneyfund.com.
And I've invested in it for over a year now, and just like you said, 8.5%. Love it. But before we get to our thoughts for the day, I just wanted to cover one quick thing. You guys see the article from China with the guy paid $35 million for the Ming Dynasty Cup. It was a little tiny cup. He paid $35 million. It took 20 transaction slips to do it because he uses American Express card. And then he totally had forgotten the benefit. He got 435 million American Express points. Can you imagine what you can be able to buy with that? I mean, not another Ming Dynasty cup, but that's a lot of points.
That's a lot of points.
That's a nice little perk there. Okay, any last, we got one quick minute last before we
Well, I just want to give us a little, pat on the back, the radio version of a selfie. And that is, we are celebrating our 4-year anniversary of the Best of Investing. We've done over 200 shows, and we are not one of those infomercials. We work pretty hard to have an engaging and entertaining, newsworthy, talk-worthy show that we're unlike some other radio shows which we've all listened to on AM weekend radio, where the guy just drones on and on and on about the same thing over and over again for 50 minutes. And I'd like to think that we actually provide some value. And in fact, when I stopped off for lunch on the way in to record the show and got myself a couple of hot dogs from Jimbo's Hot Dogs in San Rafael. It's been there for over 30 years, makes a great wiener. He said, "Hey, I know you, I saw you on TV." And so it was great, and we started talking about we're celebrating our 4-year anniversary this month. So anyway, it's been great, it's been fun, and we've learned a lot along the way. Personally, I've gotten better at radio, which is always a plus. I listened to the first 6 months of shows. I did stumbling over it.
200 shows, and you haven't gotten sick of me yet.
Okay. So anyway, thanks Edward for a fun run, and we're going to continue to go do this as long as we can until they drag us out of here.
Until we drop dead. Again, Kathryn Harris, again, thank you for joining us yet again.
Pleasure.
Always a pleasure. Okay, here's our thoughts for the day. In Japan, letting a sumo wrestler make your baby cry is considered good luck. Gee, that's kind of easy. Just give the wrestler a knife and a fork and have him lick his chops when he's looking at the kid. Just a tiny appetizer. I mean, how can you not cry when you see something that big, right? And Richard Nixon was speaking at Disney World when he famously declared, "I am not a crook." Now, my guess is he was probably in Fantasyland at the time.
Yes.
All right, audience, tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. Hopefully we'll get some special trivia contests coming here pretty soon.
I think we should.
I think we should too. All right, thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long. Good, that was a good show.
Yes, it was.
Good.